The question anyone looking at an ISA or pension will ask is, where is the best place to grow my money? With interest rates stuck at an all-time low and inflation eroding the value of your money, the answer is to invest in the stock market for the long term. Long term because the stock market has a habit of lurching up and down. So to stand a chance of getting the best return, you have to invest for at least 10 years or more. The trouble is the prospects for the UK and other developed countries look pretty cloudy at the moment. The huge debts built up by Western governments before and during the financial crisis will depress their economies for years to come. Although it's not impossible to invest in the UK, an increasing number of investors are looking to the so-called emerging markets where they see better growth opportunities. But what are emerging markets, and are they a good place to invest? The term emerging markets is used to refer to a wide range of countries in Asia, Latin America, Eastern Europe and Africa that are, to varying degrees, catching up with the West. It's wrong to think of emerging markets as one block. Each of them are individual nations with their own histories and cultures and specific challenges and opportunities. Nevertheless, many emerging markets share the following characteristics: an abundance of natural resources, but with much lower incomes than we have in the West, young and rapidly growing populations, and a lack of social security that makes their people keen to work hard, governments that as a result do not have big debts and are therefore prepared to spend money on infrastructure to improve the lives of their peoples and modernise their economies. And all of this is happening amidst a huge urbanisation trend as people move from the country into towns and cities. Of course, emerging markets are not without their problems. Many suffer from poverty, inequality and corruption. The presence of authoritarian regimes mean that in many, the lack of fully developed legal and property rights can make investing in them hazardous. Emerging markets are definitely high risk. Our 10-year chart shows emerging markets swing up and down even more than the UK stock market or global stock markets as a whole. When developed markets are rising, emerging markets tend to do even better. Look at the 40% gain in 2003 and 59% surge in 2009. But when markets fall, emerging markets fall furthest, crashing 35% in 2008 and 17% in 2011. This volatility is largely caused by the herd-like behaviour of overseas investors who pile in and out very quickly. For the longer-term investor who can stomach the ride, though, the rewards can be huge. In the 10 years to the end of 2012, the MSCI Emerging Markets Index, which is what we're looking at, grew by over 400%. Global stock markets returned just 162%, with the UK's FTSE All-Share Index doing a bit better with 170%. But don't get too carried away with these figures. The 5-year returns from emerging markets are nowhere near as impressive because of the financial crisis. Going forward, emerging markets probably are a better place to grow faster than Western developed nations. But emerging markets operate in a global economy. Their growth is likely to be more subdued because of the sluggish economy in the West. So how do you invest in emerging markets? As ever, investors have a few choices. You can put your money in a fund tracking an index like the MSCI Emerging Markets. Long-term returns from emerging markets trackers are very good, although they will passively follow markets up and down through good and bad times. Alternatively, you can invest in an actively managed fund that seeks to buy shares in the best emerging market companies. Long-term, however, most active funds don't beat the returns from an emerging markets tracker. That said, there are a few that have done much better, so do your research, find out which ones they are, but bear in mind, past performance is not much of a guide to the future. And don't forget about bonds. These are the IOUs that countries and companies issue when they're borrowing money off investors. Bonds pay a fixed rate of interest and tend not to grow as fast as shares, although they've done very well in recent years. The bonds market is under a bit of a cloud at the moment because the threat of rising interest rates and inflation could hit future returns. That said, emerging market bonds could do very well in future as their economies grow. There are emerging market bond funds specialising in this area, so have a look at them too. I'll finish by reminding you that you can tap into the emerging markets theme by investing in UK funds and companies. For example, the top holding in one emerging markets fund is Unilever, the UK-based consumer goods giant that operates in most emerging markets. It's proof that investing begins at home, even when it's emerging markets.